I never thought that this fire burned down our house. I didn't even think it would. And especially all three, I was told that 56 out of 60 burned on our beach. I don't know how much burned in my own neighborhood, but I keep running into people from the neighborhood, and most people's houses are burned.
The first weeks of the new year were marred by destruction and devastation in Southern California as several fast-moving wildfires burned through 63 square miles of the Los Angeles area, leaving more than 14,000 structures, including homes, businesses, and schools, decimated in their wake, and killing at least 27 people. Damage and economic losses from the disaster are estimated at $275 billion. Insurers in the state now face tens of billions of dollars in payouts.
It's going to be a massive number, and the full scope of the damage is still unclear, but preliminary loss estimates are running in the range of $30 to $50 billion, and that will be the largest fire-related catastrophe globally in history.
Some people liken the insurance industry to the canary in the coal mine for the climate crisis. The canary is just about dead.
Adding to the chaos is a shifting and at times confusing California homeowners insurance market. Since 2022, 7 of the top 12 insurers in the state have stopped renewing and writing policies in high-risk zip codes. Other insurers have pulled out of the state entirely. And it's not just Californians who are facing severe climate risks. 44% of all U.S. homes are in areas that face at least one severe or extreme climate risk. That includes flooding, wildfires, heat, wind, and air quality risks. So that leads many to ask, do insurance companies have the reserves to cover this disaster, and what will be the cost for homeowners to insure properties in the future?
This is going to take years to rebuild in this area. The cleanup is going to take months, but I'm also concerned once we rebuild, whether we will be able to find insurance. Those are some of the lingering questions that I wake up at 2:30 in the morning and think about.
Joan Zoloth lives in the Rambla Vista section of Malibu. Her family owns 3 houses in the area: Zoloth's home, a beach house that belonged to her parents, and her son's home. All 3 burned to the ground in the recent fires.
And there's so much loss that it's devastating. I mean, my son is complete shock because he lost everything at his house.
Zoloth purchased her property last summer. At the time, she applied for homeowners insurance with USAA, a financial services company that provides insurance to members of the military and their families. The company rejected her application.
And when I said, look at our policies, look how long we've been USAA members, the person was incredibly dismissive and said no, and not giving any reason, just said we're not going to give you a homeowner's policy there at that address. And I was really devastated because my parents had been policy holders since probably I was 6 years old.
California homeowners like Zoloth have faced a dwindling marketplace in recent years. The state's largest insurer, State Farm, announced in 2023 it would stop writing new property insurance policies in California, citing construction costs and increasing wildfire risks. 9 months later, it discontinued coverage for 72,000 homes and apartments in the state, citing the company's financial health, inflation, regulations, and exposure to disasters. By 2023, State Farm's California surplus was down to $1.3 billion, compared to a $4 billion surplus in 2016. More than half of California's 39 million people are estimated to own their home.
The climate's getting worse, and we're having more extreme and severe weather-related events that are causing more damage, that are causing higher insurance payouts. But we're also shoving more people and businesses into harm's way.
Well, over the last decade, for every dollar of premium, homeowners insurance premium that we have taken in as an industry, we've paid out $1.17 in claims. Now that's simply not sustainable. There is no endless pot of money that insurers have to be able to pay that kind of claim ratio.
And it's not just California homeowners facing hardship. Insurers have also been limiting underwriting in parts of Florida, Louisiana, and Texas as natural disasters grow in intensity and cost.
And as a result, we have these more extreme and severe wildfires, which become catastrophic and kill people and injure people and damage homes, and then also make it very challenging for insurance companies to keep writing insurance.
State Farm said in an email to CNBC that it is focused on meeting its customers' needs and that it is working closely with the state of California to create a sustainable insurance market. USAA did not respond to CNBC's request for comment. On top of the severity of disasters, California's regulatory environment adds another hurdle for insurers.
Part of the problem is there has been rate suppression in California due to Prop 103 regulatory framework. In other words, the rates that have been allowed for insurers are far below the actuarially indicated rate that's needed to cover the risk of loss.
Proposition 103 passed in 1988 and required the state's Department of Insurance to approve property insurance rates and ordered insurers to roll back rates by 20%.
Particularly in California, insurers really up until the last couple of months couldn't use risk modeling in California in their rate making. There was prohibition against it, and so they didn't have the benefit of having the latest data when it came to making decisions on their risk appetite.
And rising costs are another issue.
Over the last 5 years, construction services, that is the carpenters and the labor, that cost has increased by 35.1%. And the cost of construction goods, materials, has increased 37.3% over the last 5 years as well.
The loss of home insurers in the state has forced many homeowners into what is called the insurer of last resort, the FAIR Plan. The FAIR Plan is an insurance pool in which all licensed property insurers in the state must contribute to. It offers coverage to residents and businesses in vulnerable and wildfire-prone areas who can't obtain coverage from private insurers. Between 2023 and 2024, the FAIR Plan saw 40% year-over-year growth in policies statewide. In the Pacific Palisades, FAIR Plan policies grew 85% year-over-year.
We had to go with the FAIR Plan. This is incredibly shocking and devastating, and there's a lot of losses there. And I know that FAIR Plan must be incredibly overwhelmed with all these people calling and all these people needing help.
Now, the FAIR Plan could be on the hook for $8 billion in losses from the fires. But as of January 10th, it only had $377 million to pay claims, as well as an additional $5.78 billion in reinsurance. Now, reinsurance is a big piece of how insurers cover large-scale disasters. Think of it as insurance for the insurance industry. But if the FAIR Plan can't cover the losses, those member insurers could have to contribute an additional $1 billion for homes and commercial structures.
If the FAIR Plan runs out of money to pay these claims, and by all accounts, it probably will, every insurer that has operated in this state for the last 2 years will have to pay in proportion to its market share.
The plan also caps its residential payments to policyholders at $3 million, which means homeowners in high-income areas could find they're underinsured.
That's a problem we see after every major natural disaster is consistently people are underinsured.
There's so many people trying to access information because the scope of this disaster is huge, and there's so many people on FAIR Plan now.
Despite those challenges, experts say insurers should have the means to cover those claims.
The insurers have adequate reserves because they're required by regulation to have adequate reserves to cover these fires. This is what industry analysts call an earnings event, which means that it's going to impact their earnings. However, it's not a capital event. In other words, they've got reserves for exactly this purpose.
Again, the reinsurance market also plays a huge role in paying for these disasters.
Reinsurance is a critical part of how we finance catastrophes, not just in the United States, all over the world. The benefit of reinsurance is that you have a global spread of risk, and so insurers have varying reinsurance contracts.
The problem for policyholders both in and outside of California is private insurers will likely be looking to shore up losses following the fires, meaning higher rates could be coming for all policyholders.
when you have a catastrophe of this magnitude, you're going to see insurance costs, not just in California, but all over the country, go higher.
It's not going to be a solvency problem for the industry, but it certainly is going to affect pricing going forward, and also perhaps availability in some cases, because insurers are going to have to make decisions about their risk appetite.
The last thing we want to do is to have to retrench or pull out of a marketplace. But it takes all of us working together to create a healthy, functioning insurance marketplace.
So many people have lost so many memories, and the letter my dad wrote me telling me how much he loved me is gone. And it sounds crazy, but I was thinking about my KitchenAid mixer. You remember all the cookies you've made, all the homemade pies for Thanksgiving, and there's so much loss that it's devastating.